Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Tuesday, October 6, 2020. What we're going to do in this video is we'll keep it strictly on the broad markets. Most of my focus in this one will be on the small caps. I will start out here with an update on the Qs. I do think that's very important right now, where the tech-heavy FANG stocks, market leaders, go from here, and there's some big levels to watch that I think can determine, what the next tradable trend from this point will be. So I'm going to start out there, then I'll roll into the small caps, and then I'll roll into some of the individual stocks within the small cap arena. That's the Russell 2000 index, and even a sector or two there that stand out. All right, so just a quick recap on the NASDAQ 100. I'm still, a lot of my focus remains on that index. This to me has been a big level here, about 11,550, and that level has capped all these advances since the big correction right here off the early September high started. That's, was a divergent high. Those negative divergences played out. We had a sell signal there, breakdown, and then the biggest correction that we've had in months that culminated with this divergent low right here, which is obviously that's bullish, positive divergence. And that was the technical catalyst for this rally so far. Now we've only retraced about half or so of the move down, and again, this is a level where so far all these rallies have been checked. And so the more reactions you have, the more valid that resistance level is. So I think a solid break above there would be bullish, especially if it's anything more than just a little break and a whipsaw signal. Remember, the market's full of those, but we'll see what happens. Take it on face value. We break out. Now you want to see us get above. We had a little brief failed breakout attempt there. Obviously, you'd want to see those recent reaction highs cleared. Otherwise, the pattern has been so far rallies up to that level have been good times to exit longs and or add to shorts. So you can take it one of two ways. If you don't short at this point in time, would it be objective to go long? In my opinion, no. You don't go long right before or right into resistance. You go long in a breakout above resistance. So those already long or wanting to be long, I think the most objective entry is on a solid break above with a stop depending on where you're targeting. Stops, well, if you're targeting for the a move to new highs and beyond, you can obviously use a much larger stop. And if you're only targeting, let's say, a move up to that next resistance level at 11,704, 705, or that resistance zone up there, that's been a potential target zone for a while, you would obviously use a tighter stop there. Now, on the flip side, for those that think we're going to turn down here soon, and a case can be made either way, then an objective short entry at or maybe just below that level. We've already hit it a couple times. So anywhere from here, we're less than 1%. I think we're only about 0.5%, 0.6% below that level. So certainly objective now with a stop somewhat above, particularly above those recent highs. And then depending again where you're shooting for, maybe you're only looking for a pullback. That's pretty good support there, about 11,167. Anything much below that, I think, would open the door to run at and probably below those lows. But first things first, we're in this trading range. You can see that for the last we've actually had quite a bit of trades in this range here. Looking at box set in there, you can see it was resistance down there, and then we had quite a few trades in there as well. So that's it in a nutshell. Not to oversimplify things, but bullish scenario, bearish scenario, still my preferred scenario. Again, we've been checked there every time, so we're getting back to where it's an objective short entry, or again maybe an objective long if we can punch through there with conviction. All right, next up, QQQ, same thing. This is just looking. You're not seeing as many reaction points because we don't trade around the clock like the futures, but there's that level about 280.32 to maybe 282 or so because of the recent pop above, and we had a little spike right there as well. And that's it. So we rallied back to resistance. We're coming off a divergent high, negative divergence, and although it's possible, I don't think that's all that we've had enough of a correction for that divergent high. And my convictions aren't very high, but that's still what I'm favoring right now. And obviously, if we break above there, that's going to change the technical landscape. It's going to be a pretty important level if it's taken out with conviction. And just one quick final note to that. I've been doing this long enough to know, and you read enough about trading and investing. Emotions are almost everything there. It feels bullish after you've rallied for a week or so, and you've rallied, 5, 6, 7%. Just as it feels bearish when you've been dropping for as long. And bigger picture, if you take a step back, turn off all the lines, that's what we're doing here. We're chopping around. So, yeah, you felt bearish there. It felt like the market was going to continue to fall there, there, there. It felt bullish there. It feels bullish, lately. So don't get confused with a market that feels like it wants to go up or is going up. And there's nothing wrong with trading a trend if you have a strategy on how to trade that trend. But more importantly, recognize when it's over or likely to be over. And again, the case I'm making here simply is that we've run up into resistance, and pretty significant resistance with negative divergence, and we're still below that resistance level. And just like we're here at support, support, support. Okay, now I want to talk about the small caps for the remainder of the video. All right, all the way back here in early August. It's been a couple months. Posted sell signal on the Nasdaq 100. I give you charts of RTY, the small cap ETF, as well as IWM. This was it. It was a breakdown of that small rising wedge pattern. Laid out targets, and I since followed up quite a bit on that. And I also covered it in advance in the video, that wedge there. And again, so this is a chart back from the 12th, the day after the breakdown. Let me close that one out. All right, here we go. So that's it. And we stair-stepped lower. I added these targets as the correction got underway. Current minimum preferred swing target, and that's just as it sounds. That's where I'd figure at the very least we'd head down to, and then potential target zone. So you can see what we did is we took out that minimum target, made it a little way below that, but then put in the divergent low at the same time. As I mentioned, all the indexes did, not just IWM. We had QQQ, SPY, everything put in those positive divergence, futures, the ETFs, and so that was a catalyst for what's been a heck of a rally in the small caps right there, about 11% since then. So they've outperformed. Now, where are we at right now? Well, number one, after an 11% rally, you tend to become overbought, especially with very few corrections along the way. So I'll highlight that here. This is the RSI on the 60-minute chart. We were overbought just before that drop. Now remember, the drop was about, if I can hit it there, about 11.3%. And we haven't even come all the way up back to that high yet, so we're still below there. And so far, again, heck of a rally, but you can see here a series of, well, not so much lower lows anymore because that one took out this previous one. We're right at this other line. What I'm going to do is show you we're pretty much running into resistance. You have this reaction high here from, you can put the crosshairs there, that's around September 2nd, I believe, and you have that high just before that when you had that rising wedge. So okay, so bottom line is on this 60-minute time frame, we're overbought, rallying into pretty significant resistance. That would be the previous high. So right now, despite a very strong trend in IWM, the risk reward is no longer favorable for taking new long positions. In fact, I'm looking for a pullback in the small caps, and I'm going to continue to tell you why. Okay, here's what it looks like on the futures. RTY is the symbol for the small cap futures. That was, I believe, yeah, that was that same uptrend line, and not everything was drawn here. You had the negative divergence and all that heading into the high. There was a sell signal. We stair-stepped lower, put in one divergent low there with a pretty nice rally, and then put in another divergent low, and that was it. So this is the same chart we're looking at on IWM except via the futures. And the same story here. You can see, here, I'll take away this trend line. I'm trying to draw an uptrend line. It's so steep, but about, give or take, 1592, we're at resistance. You have a major reaction high right here, as well as that previous one right there, a little bit above there. So, we could go up a little bit more and then hit that reaction high. And so that's it. Same story, overbought. And negative divergences down here. You can see the indicators are making roughly equal highs, maybe slightly lower, with the with prices making higher highs. That's negative divergence. So that's one reason. Overbought at, well, three reasons. Overbought at resistance with negative divergence. Those are the three reasons why, again, does not mean that we can't go higher. Doesn't mean we can't burn through these divergences by bringing these indicators up. It just means what I said. You put the odds in your favor. I've got three reasons right there that all come together where it says the small caps are probably looking at tough sledding from here on out. In other words, most of the meat of that bone's probably been milked right there on this rally before we get a correction. Where would a correction go? I think at minimum come back here at about 1546 and quite possibly more. Let's take a look at the longer term charts. Let's look at the daily chart of IWM. And this is kind of a messy chart. I know you're seeing a lot of lines here, but what I'm going to do is box in, then I'll turn off all the lines. I haven't had time to clean this up, but I'm going to try to show you the salient points here. Here, maybe I'll do this, turn the lines off. All right, so what we had is, let me just turn them back on, box it in this way, and then I'll turn the lines off so it'll look a little more clean here. See this range here? See this blue line up top? And then the purple line on the bottom, which I just dragged down to. That is where, since 2017, that is where IWM has spent the majority of its time trading in that range. There's been one period where it popped above, and then we formed a bearish rising wedge, tried to break above there, failed, and it failed pretty impulsively. We overshot, went down to the bottom, but then sprung back up with a V recovery, and then look, traded boom, boom, boom for months back within that range. There was trading in that range, trading in that range. And then we had another false failed breakout attempt to the top, where we went over there for a couple months, and then boom, the bottom fell out, and another V recovery that put us right back into there. So I'm going to turn off all the lines now. And one way to see that too is the volume at histogram, volume at price histogram will show you that's where the majority of trades in recent years have occurred. See these lines right here that I just turned on? Hopefully you can make those out. Let me make them nice and bright. Yeah, that's it. I have them turned about all the way up. And that tells you that in the past few years, and whatever time frame I'm looking at here on the chart, where these spikes go out, that shows you the majority of trades have occurred there. We were there for a brief period above, brief period below. It was a big move down, but we V-shot right back in there, and there we are. So we're at the top of this multi-year trading range in IWM. Let me turn this off. And again, those volume at price histogram bars are useful for that. I can see it here clearly on the chart. That's where I had those colored lines. And I just want to point out we're near the top of that range. Does it mean we can't break out? No, we could. But typically when you get back in the range, the MO, other than in this case, has been trade in there for a while. And then bigger picture is that IWM, say what you want about the big tech heavy NASDAQ 100, got to give it credit. That's what everyone's been buying. But these small caps are still and have been in a bear market for years. They peaked back in 2018. That was your all-time high in the Russell 2000. We put in a lower high back around late 2019, early 2020, and we've been making lower highs since. So that's you want to call it a bear market. I mean, obviously we had a bear market there. Again, what metric you use, I think it's all semantics. The old definition of a bear market is a drop of 20% or more. Well, the small caps are more volatile. There was a 28% drop. Some of these along the way were 20%. So you can say several bear markets, but bottom line is, again, when you peaked back in 2018, you can't, and you've had a drop from that high up to a drop of about 45%, then you're still in a bear market until you take out those previous highs. Okay, and so turning back on my lines here, I'm going to zoom in a little bit. Remember the blue line here at about 160, we'll call it 161, 160, give or take. That's the top of that trading range I was looking at. And so what stands out to me, here, I'll turn off all the lines again, I'll just draw them out, is you had, at this point in time, when you rallied to the top of that range, you had negative divergence, clear negative divergence on this daily time frame. We're almost to that previous high now. And any equal or higher, as long as it's just a marginally higher high like this, you can just extend these divergence lines. So we're going to have negative divergence. So you have a potential for another failed attempt breakout level. Breakouts that occur with negative divergence and overbought conditions have a much higher rate of failing than breakouts that don't. So, more bullish scenario, in my opinion, would be for IWM to consolidate for a while. Maybe work off the divergences, work off the overbought conditions, and then break out down the road. But again, with the overbought at resistance with negative divergence, both on that 60-minute time frame I was just showing, I started out with, as well as this daily time frame, increases the odds that, or at least tells me that the upside potential right now is minimum, and the risk reward is actually skewed to the downside despite the current strong trend. Now, with that being said, we don't have any sell signals, but there's two objective ways to short. A, on a sell signal, such as a break of a bearish chart pattern, a well-defined uptrend line, or horizontal price support, or you short a rally into resistance. So it's a little bit more aggressive, but the nice thing about it is when you have a well-defined resistance level, you can put your stop somewhat above it. Okay, and to just wrap up, we're going to look at, I have a watch list that's off to the right of the screen. You can't see it, but I have all the holdings of IWM sorted by market cap. So it kind of gives you the idea. The bigger ones are, by the way, IWM is much, much more diversified and balanced than QQQ. QQQ, the top 5 holdings make up the bulk of the entire returns because they're so heavy market cap weighted. You have much more balance than the IWM and Russell 2000. In addition, of course, you have 2000 stocks. But I'm going to start here. I'll move on quick. This one, IMMU, that when I've seen this, and I haven't looked into this, I don't know the first thing about it, but I've never not seen a gap up and then this flat action, and it's not be a buyout. So I can tell you with 99.9% certainty that that's a buyout, meaning that one is not going to go anywhere, can no longer contribute to any gains in the Russell 2000. That already did, since it's in it, that big gap up, and looks like it was a premium of 100% when that one got bought out. But again, it's stale now until what happens when the buyout's complete. It's no longer in the index. So we'll look at the rest here. And I'm just going to rifle through these pretty quick and show you a common theme here. Again, this is that one was 19.6 billion market cap. This one's 16.5 billion. TDOC, Teladoc Health, obviously a big thing. Since coronavirus, that's all I've had, 2 video conferences with my doctor. He won't see me until I'm asymptomatic, of course, and so that's I might even be the one they're using. I don't know if that's the service or not, but again, a big thing, this whole video conference. However, let's just talk technicals and other things here. There's big negative divergence, and that's the common theme on a lot of these. So on one hand, the trend is bullish. I need to say that, and if you're not an aggressive trader, recognize that, and what you want to wait for are a lot of these stocks to break support. There's your clean uptrend line. A break of that uptrend line with these divergences will most likely play out for the next trend reversal and move down. I'm not going to lay out targets on each of these because I'm really focused on the NASDAQ 100 right now. Just like you had back here, uptrend line, negative divergence, there's your breakdown. This is what you want to see. I talk about convincing, impulsive. That's what a breakdown should look like. Nothing but red sticks, for the following week or so there, impulsive selling, and since that breakdown signal, if you took it, that stock dropped 45% from there, and in relatively short order. LVGO, the next one, you already broke trend. There's a trend line, not super well defined, but a pretty good price channel and negative divergence at the highs. It's kind of holding up, and I think that's largely because the Russell 2000 is holding up. It's still below its recent peak, but again, I'm pointing out a common theme here that most of these companies, GNRC, Generac Holdings, this one I was quite bullish back and made the fundamental case a couple years ago when California had the first, not the recent wildfires this year, not even the ones before. A couple years ago, they were really bad. That's when PP&G, or PGE, Pacific Gas and Electric, said they would start doing rolling blackouts. I focused on the generator stocks, and this one being the most pure play as huge for that reason, and you can see it has been. It's had a heck of a return, but it's come full circle. The stock rallied about 700%. Again, I think big beneficiary to, the people that have health conditions or businesses, restaurants, everything. When you know you're going to have rolling blackouts, when they tell you in advance, when the wind's blow and the fire's up, we're going to shut the grid down in certain areas. That's going to lead to generator sales. However, how much of that 700+% return has been priced in? And now you can see we have the first negative divergence building since this one right here. We had a divergent high right there that led to that 35% drop in COVID. When the first COVID thing hit, there was another 12% drop when the previous divergent high, and you can see here. So no sell signals as of yet. There's your trend line, but in this case, again, we'll look for maybe some type of bearish candlestick reversal pattern. And again, more importantly, I want to point out the common theme. I'm going through the largest holdings in the Russell 2000, and the common theme that I'm seeing are these divergent highs. Negative divergence, that means these indicators are making lower lows, prices are making higher highs, and usually those are followed by corrections. That's NVCR, by the way, Novocure. Next one up. ENPH, Enphase Energy, continues to diverge, moving higher. It's in an uptrend. That's why I always say divergence is not a sell signal. The divergences play out much more often than not, but not 100% of the time. That divergent high right there, the first one, did play out for a nice healthy correction, and then the uptrend resumed. That was about a 46% drop. So it doesn't look like much. I use log scaling in my charts, guys, and that's going to put things. I highly recommend log scaling, especially on, when you're looking at stocks that have a range on the chart, like right here, from high to low, this stock had rallied, or from low to high, 2,250%. If you don't use log scaling, usually you get a distorted picture. There's an arithmetic scaling, and it just doesn't paint a true picture of what the stock's done. Log scaling puts all the price moves in equal percentage terms, not dollar terms. Because when a stock is at $4, if it goes to $8, that's 100% return on a $4 share price increase. When the stock is at $8 and it goes up, $8 and it goes up $4, then that's a 5% increase? So big difference, and log scaling will correct that for you and show you what the true picture of the stock looks like. Either way, divergence, no sell signals, in an uptrend, but again, everything's getting extended, and that's a common theme, just negative divergences across the board. I'm not going to go over each and every holding. I'm going to get to maybe 5 more and then look at one sector that stands out. This is SAM, Boston Beer, a little megaphone pattern, or ascending broadening wedge, you can call it as well. Negative divergence. So still in an uptrend for now. AERS, Aries Management, major reaction high right there. It keeps getting checked here. It's popped above it, just like it popped above there briefly, and divergences continue to build. So this one will, may continue to run for a little bit, but chances are, like I said, breakouts that occur with negative divergence and overbought conditions usually end up failing. Run, I think I mentioned some of the solars the other day in one of the videos, getting very extended, negative divergence on just about all of those. This is Sunrun, symbol is RUN. ODEL, or QDEL, I'm sorry. That one already had a bearish rising wedge, broke down. Again, there's what you want to see. See that big red giant impulsive candle? That is confirmation of a breakdown. It doesn't get any better than that. From that point, let's say you waited to the end of the day. There was plenty of opportunity. You can see the breakdown forming. You could have certainly got a better entry point, but from there the stock still had another 41% downside to fall. What's the stock done since then? Well, it had one leg down, a little counter trend rally, so more of an ABC correction. ABC, but it's rallied right back up to that. That's a pretty decent resistance right there, about 252.13. Right there, you can see quite a few reactions. CHGG, another bearish rising wedge. So here's a theme. Some of these have already put in these divergent highs, and the divergence is already starting to play out. They have corrected, and the $1 million question is: it over, or is this just a counter trend rally with more to come? I think this stock, looking at the chart, looking at that wedge, comes down here at least that 54, 54-ish support, big gap right there to backfill, or at least test the top of. And if it backfills, which depends where we go. You know, I always say the charts are dynamic. I can't tell you right now, but if we start moving down, we get close to that level, and I do an update here, I'll let you know my thoughts if I think where the gap's going to be backfilled. For now, we need to, of course, see the reversal. Penn. All right, so this is where I'm going to go after this. We're going to look at the casinos, and we'll wrap it up. Penn National Gaming is one of the casino resort and casino stocks, and these to me. I'm just trying to get my my head around the fundamental cause for this rally. A lot of the casinos up until COVID, until the government came in with all kinds of supports, they were not allowed to qualify for government aid. Then they lobbied and got that changed, although they couldn't qualify. And this may have changed since I've read about it. The payroll protection program, if you had 500 more employees, you wouldn't qualify. So a lot of the bigger casinos wouldn't qualify for that, but they did, I believe, qualify for other loan provisions. So it was a stay of execution, and I don't, I live in Florida. The only gambling we have here are at the Indian resorts. They have casinos on the Indian reservations, and I don't frequent those. I don't know what the gambling scene is like. I welcome feedback from those of you that live in states, such as Vegas that has it. But to me, this is just crazy that the stock is trading at all-time highs. With COVID still very much a real thing right now. But from a technical perspective, forget about the fundamentals. I haven't done any due diligence fundamentally in these companies, so I'll just say from a technical perspective, big bearish rising wedge, very overbought, and probably extremely overvalued would be my guess. Minimum, well, I can give you minimum targets, but I think when this one breaks down, it's coming back at least before all is said and done, meaning Zigs and Zags is going to backtest that 39.23 level. So you can see the trend line I have. That would be your objective short entry. That would be a drop of about 45%. So that's my pull from where we're at now. We wedge a little higher, then I have 50+% downside, and I think that's where again Penn's going before all said and done. I'll rifle through a few more of these, and then I'll give you an ETF that's an option. LVS, Las Vegas Sands, obviously has not recovered all the COVID drop. Some of these lines, guys, I've had these lines on my charts for years, so they're not all marked up and a little bit messy. There's the COVID drop, rallied back. It's got a lot of supply or resistance around here. Just traded on that area a lot, and that's kind of where it stalled out. So there's one that it's recovered some, but not all of its losses. Probably not one of my favorite shorts for the next leg down when these casino stocks roll over. But again, I want to just cover some of the big ones. MGM, again, old chart, old lines here. You can see old targets that were hit. Long and short trades on this one. But the big thing is I have a boxed-in range. These are a lot of old support and resistance lines. But you can see here, really, for years, this is where MGM has traded. And again, it's kind of like this is in the small cap index. That's why I'm going through, I believe this one's a component. I flipped over now to a different watch list. I think this one's in IWM, not 100% certain. But like IWM, I am certain it's been in a trading range. It's spent most of its time in this blue box. And so the bottom of that is the resistance. It's the bottom of that trading range when you're below it. And boom, boom, boom. That's where this one's failed so far. And in my opinion, that's probably more than it should have recovered with COVID. COVID one day will go away, probably. They'll maybe be like the flu. Maybe it'll be around every year, different variation. They'll eventually have a vaccine. This is my guess. But look, the world's only getting more populated, more crowded. And we're going to have other infectious diseases. I think that's people recognize that as a new norm, and it's going to change a lot of business models for places like this that require a lot of indoor close contact and things like that. So Penn National, I think I already hit on that one. Yes, I did. MTN, Mountain Vale Resources. Again, common themes here: divergence at resistance. There's your negative divergence. Win, rallied right back to about where it should have. There was that multi-year trading range, hit the bottom of it, and it's been bouncing in this range. So when these stocks break down, which I suspect they will sooner or later, that's the short entry right there for Win, a break below $69. That's capped all the recent pullbacks since the little V-shaped recovery there and that rally up to there. And it's also a trading range. If you're just an active trader and you like ranges, watch, rinse, repeat. Go long at the bottom, and if it gets to the top, you go short and buy at the bottom. And you can see it's kind of often stops halfway in the range, so that might be a better way for a swing trader. Buy at the bottom, sell at the top of the range, short, go back down to the bottom. If it breaks the midpoint, you can rally up to the top. You can go long again if you want, but that's it. So, and of course, again, break down below 69 would open the door most likely for another leg down. And next up, Caesars Entertainment, CZR, just again, right back up to its previous, or close to previous all-time highs right before COVID hit. This time with negative divergence, overbought. Back then you can see negative divergence right here, heading into the COVID highs. So similar technical posture. And that's a big part of my trading. You guys, if you're interested in this, and I encourage you to do your own due diligence, check out the fundamentals of these companies. But from a technical perspective, that's it. You look for these uptrend lines, look for negative divergences, and then wait for your sell signal, and then boom. In this case, there's your uptrend line, there's your negative divergence. It's kind of sloppy because IWMs are rallying. We're below, but not impulsive. This is what I talk about. That is not an impulsive breakdown. It's not the most well-defined trend line because I'm coming off here on the lows. I have a couple reactions here and a couple more recently. But I think if we zoom in tight, we're below that trend line, and I can see this recent area of kind of sideways consolidation. So my guess, and I think what would be an objective short entry, especially if you see breakdowns in other casino stocks, is a break below that recent trading range. And where does it go? Again, that would be a separate video. I'd have to identify targets. Always look for these reaction lows as likely targets as well. That'd be about $29. So that would be, if hit, about a 50% drop in Caesars. All right, and that's it. I could go over all these. Boyd Gaming, Rising Wedge, negative divergence, same story. And also in this one up to previous reaction, that's resistance. There's a line that's been on there for a while. I had that line back from 2018 as a resistance support level, and it's right about 33, and that's what we rallied into. Red Rocket Resorts rallied into resistance, negative divergence, and that's about it, guys. The rest of these will go down the list. There's smaller companies. Oh, and then to leave it with an ETF, if you don't like individual stocks, you like an ETF because you're a little more diversified. Here's BJK. It's the Van Eck Vectors Gaming ETF. Negative divergence as well. Some of the holdings include the one I've highlighted the other day, DraftKings. I did that in a video. DraftKings is just starting to crack. The uptrend line is not super well defined. That's where I should have had it right there. I'm putting it where sometimes these trend lines drift, right about there on these reactions. So you have 1, 2, you have a body right there on the candle, 3, couple there, and we're broken down below it today. So there's a sell signal, and that's the one I laid out targets for you. I believe I did the other day. Might have to, I might give you one more in case you're not shooting for the fences here. 47.37 unadjusted targets, actual resistance level. Cover a little bit above that if you're targeting that level. 38.23, and things get ugly down here to about 27.80. I mean, if they get real ugly, 18.20. But there it is. So, and that is, of course, in BJK, as well as the other ones in there are LVS, Las Vegas Sands. You have MGM, Penn, which I covered, Wynn. A lot of the big names in there in that BJK. I'm going to wrap it up here and get the video out to you guys. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.